Start with the basics. A fixed annuity is a contract you make with a life insurance company. You put in money either as a lump sum or through a series of payments, and in return, the insurance company promises two main things. First, they'll credit your account with interest at a stated rate, often guaranteed for a set number of years. Second, if you choose, they'll turn your savings into a predictable stream of income later on. Key here is predictability. Your interest isn't tied to the stock market, so you don't have to worry about market swings. Instead, the insurance company takes on the investment risk. It's important to remember, though, that a fixed annuity isn't a regular savings account and isn't meant for short-term goals. Early withdrawals can lead to penalties, making this product best suited for long-term planning. Now let's walk through how a fixed annuity actually works. It starts with the accumulation phase, where your money grows inside the contract. The insurer credits interest based on the contract's rules, often guaranteeing an initial rate for a few years. After that, the rate may reset, but there's usually a minimum guaranteed rate, a safety net. During this phase, you can't just take out as much as you want. Most contracts limit early withdrawals, and if you exceed the allowed amount, you'll face surrender charges. However, many annuities let you withdraw a small percentage each year without penalty. Later in the payout phase, you decide how to access your money, take withdrawals as needed, a lump sum, or convert your savings into a steady income stream. Each contract is different, so it's crucial to read the details. Fixed annuities offer several attractive features. First, you get predictable interest crediting, often with a guaranteed minimum rate. Your earnings grow tax-deferred, meaning you don't pay taxes until you withdraw money. Another benefit is principal protection. Your money isn't exposed to stock market ups and downs. However, these guarantees depend on the insurance company's financial strength. It's also important to note that liquidity is limited in the early years due to surrender charges. So, fixed annuities are best for those who don't need immediate access to their funds and value stability over high returns. If you're looking for a way to build a safe bucket for retirement or want predictable income you can't outlive, a fixed annuity could be a good fit. While fixed annuities have clear benefits, it's important to understand the trade-offs. Liquidity risk means you may need your money sooner than expected, but early withdrawals can trigger surrender charges. There's also inflation risk. Fixed rates or payments may lose buying power over time if prices rise. The guarantees you rely on are only as strong as the insurance company's ability to pay claims. If interest rates rise after you lock in, you might wish you kept your money more flexible. And if your goal is short-term savings, a fixed annuity probably isn't the right tool. Always match the product to your time horizon and read the contract details carefully. So who is a fixed annuity best for? It's a good option if you want predictable growth, aren't comfortable with market risk, and have a long-term horizon for your savings. It's also helpful if you already have an emergency fund and don't expect to need this money soon. On the other hand, if you need easy access to your funds, are still building your financial foundation, or don't fully understand the contract, it's wise to pause and ask more questions. Always consider your goals, time frame, and comfort with the product's rules before making a decision. Summary: a fixed annuity is a long-term insurance contract designed for those who value stability, predictable growth, and the option for steady income later in life. It's not about chasing the highest returns or having instant access to your cash, but about matching your financial product to your goals and timeline. Always review the contract, understand surrender charges and payout options, and check how taxes will affect your withdrawal. If you're seeking a reliable way to grow your savings and plan for the future, a fixed annuity could be a smart addition to your financial strategy.